Hello, everyone. Thank you for joining us today. Today's presentation will be about credit. My name is Terrence Brazil. I'm a community engagement specialist with Harvard University Employees Credit Union. I'm also joined by Magdalia Gomez, AVP of Community Engagement, and thankfully enough, Danielle Boudreau from HUCTW, actually. Would you like to say anything as we get started, Danielle?
Thanks, Terrence. Yeah, I just want to send out a big welcome to everybody. We love having these opportunities for our members to learn more and improve their financial wellness. And we really appreciate the partnership with the credit union that brings us such expert information on a regular basis. And I was telling Terrence and Migdalia before we started that I just bought a new car last year and was drawing on the lessons that we're going to learn today in this presentation very much in the months leading up to that, trying to maximize my credit score for that moment when I knew I would need a loan. So I'm excited we're here to learn together and thank everyone for coming.
Awesome. Thank you so much for joining us, Danielle. And as we get started, just some housekeeping tips before we get into the content. During today's presentation, we will be reducing all background noise, so everybody who joins in, you will be muted. No need to worry about any kind of dogs barking or kids in the background. We have ensured that we are able to give you the best value by keeping everybody muted. If you have any questions throughout the presentation, please use the Q&A feature. The chat has been disabled, and it really allows us to ensure we answer all of your questions and we cater the presentation so that way you get the best bang for your buck. This presentation will be recorded and it will be uploaded to our YouTube page at MyHUECU, and there will be a post-workshop survey. At the end of the presentation, I will be posting a link in the chat. If you can and have the time, please take the survey. Let us know how we did. Let us know how we can improve, because we truly exist for our membership and we love hearing how we can make our presentations that much more valuable for you. So to begin, in case you're not familiar or you're new to Harvard or the Harvard community, we are Harvard's only not-for-profit financial institution. So what does that mean? That means we exclusively serve the Harvard community and all Harvard affiliates, from the teaching hospitals to the faculty and staff to the students. We exist solely for our membership, and that's you. Thank you for joining us. We also offer a lot of better products than other financial institutions, in my opinion. Because we're not for profit, the revenue that we do earn, we give back to our membership, that's you, in the form of free financial resources such as presentations like this, and or higher interest rates on our savings accounts, and actually lower interest rates on our loans, such as the auto loans that Danielle mentioned, and or other loans such as mortgages and whatnot. So we are able to offer the same services as other financial institutions. Only thing is, we exist solely for our membership, and we have all the same things: online banking, Apple Pay, and all that stuff. And if you happen to leave the Harvard community, but you still remain a member, you do have access to our nationwide co-op shared branching network. So once a member, always a member. We'd love to have you join us. So let's jump right into it. How credit works. This presentation will cover all the aspects of credit, from credit reports, credit scores, how to potentially boost your credit score, how to protect yourself in all terms of credit, and ensuring that I really want to set the tone and the agenda so that way you know the value that you're getting out of it before I even jump into it. So let's begin. What is credit? Credit is, put in plain terms, a loan. It's when you are extended a line of credit, whether you're using it for a credit card, getting a big purchase like a vehicle, and you pay it back according to the terms agreed upon when the line was first extended, whether that's monthly payments, certain interest rates or whatnot. But at the very basic, it is using a loan now and paying it back over a period of time, and it is not using your debit card or income-based funds. Just quick distinction to get it out the way to kind of set the stage before we get into it. Now, as we're getting into talks about credit, we have to talk about the credit bureaus. There are three major ones that are widely used across the industry. It is Experian, TransUnion, and Equifax. Now, they're not all created equal. And what I mean by that is different lenders will report to different bureaus depending on the pre-existing relationships that they've had. For example, in my personal experience, I got a car a couple years ago, and I went to Honda Financial. And I, at the time, had a credit score, I think of a 720, and it was showing on my Bank of America app. And I was like, oh, this is great. I showed them the app, and I learned Bank of America was reporting to Experian, which was fine. However, when they pulled my credit, it was a little bit lower, and I wondered why. And they said, actually, Honda Financial worked with TransUnion. So that goes to show you, just because one app or your banking app says one thing, doesn't necessarily mean when you go to have your a line of credit extended to you that the lender will have to use the same bureau that your banking app does. So that lets you know the information may not be exactly the same. It should be similar, but it is your responsibility as a consumer to monitor these different credit reports and credit bureaus to ensure the information is accurate, it's reflective of what's going on, and if there's anything that you need to correct, you want to jump on that. We'll touch on that a little bit later, but I wanted to give that kind of like wet your whistle a little bit and give you some information. Some more things that the credit bureaus do, they collect information from you. They collect information about your utilities, your creditors, and anything that you have going on, and it is reported on your credit report. To expand a bit more about what the credit bureaus collect and report on your credit report, debt, account history, collections, and request history, along with your payment history. These individual factors, per se, will inform your credit score and inform lenders about how you've been using your credit thus far to allow them to make educated decisions as far as extending credit to you in the future when you request a loan. So it is good information to be aware of, so that way you can monitor it and know the exact same information that the lenders will be using. If you want to access your credit report yourself, the only place you can access it for free is annualcreditreport.com. And please bear with me as I put this link in the chat, and I'm going to tell you a bit more about it. If you are reaching out to different sites, and they're trying to charge you or whatnot, please don't use that site. This is the only place where you'll be able to get it for free. And I want to offer a bit of a tip that I've learned over the years, where you're able to only well, historically, you're only able to pull one credit report from each bureau per year. During the pandemic, that has changed a little bit, and it's been a bit fluid where TransUnion may say, hey, you can pull it every day for a week and whatnot. So I don't want to tell you the frequency that you can pull it, but I can tell you historically what they've done is you can pull one report per year. And if you want to be strategic about it, I would pull one report in January, for example, pull Experian in January, wait 3 months, pull TransUnion in April or March, and then pull Equifax in maybe sometime in the winter, November, October. So that way you're keeping as close an eye as you can on their information on your report to protect yourself from potential scams and frauds or new lines that may have been opened that you're not entirely aware of. The sooner you're able to identify suspicious activity or lines that you potentially remember opening, the more you are able to protect yourself and rectify the situation before potentially harmful impact has been done. Now, going into credit reports, and let's look at it to get a real understanding of what it is so that when you pull your own credit report, you know what to look for. This is an example of a positive impacting credit report. And by positive impacting, I mean this credit report will have a positive influence on your credit score. There's some few things I want to highlight here. This right here will show you your payment history, and there's some codes that go along with it. For example, payment status current. If I'm looking at this report as a lender, I can see, oh, Joe Schmo has had this line open since 2003, and this is currently a 2017 report. And I've seen for the most part, he's made his payments on time. However, there are some things that I want to highlight. I can see his credit limit, his balance, his current balance, his highest balance, and if he's ever been past due. And this right here, this scheduled payment. This is a little bit interesting, and there's a bit of a nuance here that I want to highlight in particular. I can see his current balance is 4,216, and his credit limit is 5,500. It's a very high balance in comparison to his limit. It's well above the 30% utilization ratio. However, his scheduled payment is only 127. So as long as he's making his minimum required payment, his status will actually report as current. And I also want to highlight this right here too. This is a revolving credit account. As we go throughout the presentation, we'll see different types of credit, and revolving is one of the types that we will be highlighting. But to summarize, this is a positive impacting credit report because payment terms are paid as agreed. He's been consistent with paying on time. And if I was reviewing this, I would honestly say I would have no problem with believing if I extended credit to this person, they would probably pay me back according to what they've done in the past. This is an example of a negative impacting credit report, where this could potentially have negative impacts on someone's credit score. All the same information. However, this situation is a little bit more unique, where this person has not made payments on time. And in fact, in this particular situation, just to add some color to this person had a bill opened in their name through Comcast, and they weren't aware of it at the time. And while the original amount is low, it's only $307, this balance was never paid. And it went past 30 days, past 60 days, past 90 days, derogatory 4 times. And it's been hurting over and over again each and every month. So if I see this, I would have some doubts and some reservations about if this person would be able to pay me back in time. Now, this doesn't necessarily mean that this person's a bad person, they're not financially well, they're not doing okay in life. It could just be that they weren't aware of it. And that's exactly what happened in the situation. They were not aware that this account had been opened and that it was negatively impacting their credit score. This goes again to reaffirm the importance of frequent checking, frequent monitoring, and really keeping tabs as best as you can on the information that is reflected on your credit report to ensure everything is accurate. Because something like this can and will negatively impact you when you go to make those big purchases, such as a car, maybe getting a mortgage, or even looking to refinance. You really want to keep a close tab on it so you're able to give yourself the best put yourself in the best position to get the best terms possible. Now, some of these things have certain timings that they will stay on your report. So, for example, open accounts in good standing will stay on indefinitely, bankruptcy 7 to 10 years, civil judgments, all this stuff. And there's a bit more nuance to this, but I only want to show this because these this credit report, these positive and negative ones, have a lasting effect on your credit report and credit score, and it does vary by time. So jumping on it early and catching anything that may or may not be accurate is the best way to ensure that you don't negatively impact your credit report for too long. If there's any throughout the chat, throughout the presentation, please feel free to put them in the Q&A, and I will 100% be sure to answer them at the end. Thank you very much. Now, what to do if your information is compromised? We currently live in an environment right now where we are our economy right now has a lot of scams and frauds going on, and it's targeting certain people, maybe an older demographic or younger demographic, and social media has made it extremely easy, and the advances of technology has made it a bit harder to decipher what could potentially be an authentic message or whatnot, and what potentially could be a scam. So the best way to, or one of the two of the best ways to protect yourself from this is one is a fraud alert. A fraud alert is an extra layer of security that you're able to place on your account with your financial institution. It could potentially be a password or setting up an extra security phrase or something, and you notify the businesses, and the business will have to go through extra steps to verify your identity before it issues credit. So that could be, hey, call me before anything is extended. Let me know, send me a text, whatever you have to do, whatever you feel like is the best way that you would like to be notified. By all means, you can do that. You can contact each of the credit bureaus to have them place an alert on your account, and that alert will last 1 year. So this is not a permanent solution, but it is a solution. There's also a credit freeze. A credit freeze is a bit more of a long-term solution where it completely restricts access to your credit report. And I've done this on mine where I have contacted Experian, I've contacted TransUnion, and they've made it really easy right now. So I can just put it on my phone. I can log into the app and say, hey, I would like to have all my credit reports frozen, and that's it. I have peace of mind. I know no one's opening anything in my name that I don't want, and I still monitor my credit report. So this is by all means not a one and done situation. So I still put a freeze on and I still monitor my credit report both and combined, so that way I'm able to have a little bit of overprotection, because identity theft is very rampant, it's very dangerous, and it's very hard to clean up after so much time has passed. Um, oh, and it's not permanent. So if I want to, for example, get a new credit card, maybe I want to tap into a new HU ACU card, and I want to get some perks with it, right? But my credit's frozen. How do I access it? I would actually go into the app. I would place a window where I can, okay, I'm going to open it up for 3 days, let my lender know that I have removed the freeze, and allow them to pull the report. And once that time period has ended, it will actually will refreeze after that, and I'm right back to where I am to 100% credit frozen. So it's very easy. It does involve a bit more work. It does involve a bit more steps to get there, but this is one of the tools that we are allowed to do to ensure our information is protected. I see some great questions coming in the chat, and I love that. Please keep it going. Thank you so much for your engagement. Next, we're going to keep going with managing your credit score. Your credit score and your credit report are two different things. I like to look at it as your credit report is more transcript, which shows your classes. For example, transcript will show your classes, where you're going to be at, your room number and whatnot. It'll show the intricate details, but it won't show you your GPA. Your credit report, same thing. What's going on, debits, accounts opening and whatnot. Your credit score will actually be a number, reflect the information on your credit report in a number format, in a quick, easy summary. And if you are looking to learn about different ways to make impacts to your credit score, we offer some great resources through our partners at GreenPath. Learning Lab Plus is a free online education portal, and it's great. It's completely free of charge, and the courses are 10 minutes long, they're bite-sized, and they go right along with what I'm teaching you right now in this presentation. And if you feel like, you know what, I want a bit more hands-on, I want to really take it to the next level, I highly, highly, highly suggest Learning Lab Plus. That is huecu.org/greenpath. And let me see if I can put that in the chat. Here we go.
Hey, Terrence, I took care of it.
Oh, awesome. Thank you so much, Vidali. Okay, now let's keep going. So what is a credit score? Credit scores are a quick summary of your credit history and your credit worthiness in number format. The ranges are shown on the screen, and I do want to communicate, no matter where you are right now with your credit score, that's not a death sentence. It's not set in stone. You're not going to be there forever. You are able to have this fluidity, and you are able to have a positive influence on your credit score. It's completely yours. You own it, and you do have the power to make changes. The same way you can positively impact it is the same way you can also negatively impact it. Whatever your score is not tied to your identity, but you are able to make it a little bit better if you so choose to do so. And honestly, why would I want to? Tell me, well, if you're asking me and you're new to this, and you want to know why this matters, I'm gonna go into it and show you the potential cost savings of having a poor credit score versus an excellent credit score. Before I get into that, let's go into what actually comprises a credit score. How do you get to that number? 35% is payment history. Payment history is what we showed on the credit report, actually. Are your payments current? Are you paying it in full every month? Have you been paying it on time? Are you paying as agreed? And these percentages, these are pretty accurate. They may change a little bit as time passes. So if at 10 years down the line, if the numbers are a little bit fluid, don't come back and tell me. This is what the information is as the moment. 30% will be amount owed. So the two biggest impacts, about 65%, are payment history and amount owed. By amount owed, it's how much money in total do you owe back to someone else. For example, if I have 3 credit cards from 3 different lenders and the limits on each of them is 5,000, so now I have a total credit available to me of 15,000. If I keep with my utilization within that 30%, I'm probably only going to be using maybe 5,000. Maybe I'll keep it under slow, like $500. But if I start to really dive into it, I'm having some financial hardships and I'm tapping into my credit card to pay off those emergencies, I'm now getting higher my utilization and my amounts owed will be a lot higher than it should be, or a lot higher than I would like it to be. There's also new credit and credit mix. Credit mix is what I alluded to earlier about possibly having a revolving credit line, installment loans, mortgage products. So each line can fit into this credit mix. And this is not to say if you only have one credit card, please go out and get like 8 more. By all means, no. You want to be able to use credit effectively so that way you and manage it properly in the way that works best with your financial situation, based on your income, based on your spending habits, and based on your own financial goals. So I'm not saying, hey, go out and get more, but take a look at it, and I'm providing you knowledge so that way you can be that much more informed in case you want to positively impact your credit score. Length of credit history is something that you may not have too much control over. This is how long you've had credit. I know a lot of us may have gotten a credit card when we were just 18. Actually, my niece, Selena, she just got her first credit card and she's 19 years old. I'm so proud of her. I'm telling her all the things that I wish I had known when I was her age. And I said, don't do anything with it. Just put your subscriptions, put Netflix, Xbox on there and set up automatic payments and you'll be fine. Have it so that way you are able to pay it off in full every single month and have it pulled from your checking account. And I said, don't touch it again. Just leave it, set it and forget it, and you'll be okay. Over time, this good habit of paying it off in full will outweigh the impact of her being younger. So she's 19, so she has 1 year of credit. As she continues to age and get older, her length of credit will no longer negatively impact her. But she's 19. I hope she doesn't make mistakes. I know she will, and if she does, I will 100% be there to support her. I want to be a good uncle as best as I can. Now, this is some of the impacts of having a higher credit score versus a lower credit score. When you are on the lower side of the spectrum, it's not necessarily negative, but there are some costs associated with it when it comes to extending credit and having loans extended to you. For example, when you're at the lower end of the range, you may be subject to a higher interest rate because you are shown to be a little bit more risky. So for the lender to assume more risk and send that loan to you, they're going to charge you a higher interest rate. That leads to higher monthly payments, and that leads to higher costs in the year. For this example in particular, this is only for educational purposes. The numbers are not exact. This example is a 36-month car loan at $25,000, and the potential costs of that same loan depending on your credit score and how it changes. So In this scenario here, we can see on the bottom end, it's an additional $5,000, almost $6,000 of additional costs after 3 years for the same loan, as opposed to a 4% interest rate on the higher end with a 741 monthly payment. This is about $250 and zero additional cost. So this really does make a huge difference when it comes to achieving your financial goals long term, because all this money could be potentially saved in interest and or repurposed towards other financial goals that you have, such as an emergency fund, investing, a savings account, what have you. And personally, honestly, this is a nice vacation. This is a really nice vacation. This is like Bahamas, cruise ship, and I would much rather utilize these funds to have fun as opposed to paying them to my lender for getting the same vehicle anyone else would and just not having to pay that money in interest. So this isn't to scare you. This isn't to say, hey, having a credit score that's lower is bad, but it's to add some tangible numbers as to why you may want to invest some time, energy, and resources into learning a bit more to potentially increase your credit score so that way you have a bit more favorable terms when you go to when you go to request lines of credit. And this is an example of what the lender will see and make decisions based on. In this example here, we have a credit score of 488, and we can see some codes associated with this. I'm not going to go too deep into this. I'll keep it pretty high level, and I'm actually going pretty quick as it is. This will show serious delinquency, number of accounts with delinquency, ratio of balance. So this tells me this member or this person hasn't really been paying their bills on time, and they may not be the person that I want to extend my most favorable terms to, and this may be extremely risky. Next up, we have someone who's kind of middle of the road, where it's not necessarily a bad credit score. It's not the greatest. I would say this person's kind of working towards improving it. They may still be qualified for more favorable terms than the previous person, but they may not qualify for the best terms. And next up, we have someone with an extremely strong and positive credit score. And I do want to show here, some of the notes still may not be completely positive, but the score is. Some of these notes stay on the accounts regardless if the score has changed, but the notes don't impact you as much as the score does. When lenders look at this, we're looking at a holistic point of view to see, all right, what's your credit story? What have you done? How long have you had it? What's been going on? Your numbers and your credit reports paint a full picture about who you are, and whether or not that picture is reflective accurately, unfortunately, may not have the biggest impact when it comes to credit decisions. So there could be a story was like, hey, you went through some hardships or whatnot, and those are fully understandable, but you want to present yourself in the best way possible by utilizing the tools that you have available to you to make positive impacts to your score, to give yourself the best option and best chances possible. There is a bit more to that where there's two different scores going on right now. There's a FICO score, as I touched on here before, and there's also a Vantage score. Right now, usually the FICO score is what is utilized across most lenders right now, but there is a Vantage score there, and the factors that make up the score are pretty much the same. Payment history, age and type of credit, percent of credit limit used, and you want to keep that 30%. That will be standard across the board, and total balances. So really, regardless if you're using Vantage or FICO, the information in this presentation will be relevant to you if you are looking to increase your score or learn a bit more about your score. And that is yourvantagescore.com. Now, I've given you a lot of information about credit reports. I've given information about credit scores and what comprise your credit scores. Now I'm going to present some options to improve your credit score. Now here's where the tools come in. Now you're empowered. You learned about why you need it. Now here's what you're going to do with it. There's some secured versus unsecured credit cards. Secured credit cards are cards that you place funds, you give funds to your lender to say, hey, my limit will be $500, and you put down that $500. So it's not just a line of credit, it's actually your money that's securing that credit card. So you're able to develop some good payment history habits over time without the lender saying, hey, this is super risky. And you're able to, it's kind of like guardrails in a way, in a way where you're looking to grow and make progress. And with a secured card, they can be useful. Most institutions offer them. Um, and they're pretty great when you're first starting out, or if you're later in your financial career and you want to kind of start making some changes. Secured cards are a great way to go. There's also unsecured credit cards where there is no financial security behind it. So there's no money saying, there's none of your money saying, hey, I have this is mine. The line can extend, and it could be 10,000, 20,000, what have you. There's a bit more risk with that. Sometimes the interest rate could be a little bit higher, but those are the two types of credit cards. There's also special loans available to you. We also have them at the credit union, and we offer debt consolidation loans, credit builder loans, and these loans may potentially have a lower interest rate when it comes to credit cards that are offered elsewhere, and they allow you to consolidate multiple lines of credit. And by consolidate, I mean, let's say you have 2 to 3 different credit cards with different balances, and you have multiple monthly payments at different times. You might want to consider a debt consolidation loan, so that way you make one monthly payment, you have one interest rate, and you're able to pay down the balance stretched over a longer period of time. So instead of saying, hey, I have to pay this off every single month or it's a lot, you can say, you know what, I'm going to take all the balances, put them in one loan, stretch it over 5 to 7 years, one interest rate, one payment, and keep it going. And there's also options to reach out and say, hey, I would like some bit of extra help. We offer one-on-one financial counseling through GreenPath, and you can talk to a representative. They speak multiple different languages, and they'll be able to help you and give you a tailored, very specific to your situation solution to how to get out of whatever financial situation that you're in right now and potentially transition into a more favorable one, or one that's more aligned to your goals. That's huecu.org/greenpath. They are I, I'm a huge believer of them. They offer extended hours, so it's not just business hours 9 to 5. I think it's 10 to 6. They speak over 100 different languages, and if you're looking for a specific language that they may not offer, they'd be more than happy to see what they can do in their network to get you the resources that you need. Now, let's jump into choosing your credit card. This is the Schumer box. This is required to be with each and every credit card at sign up, so that way you are able to review the terms and compare them with other credit cards, and they can be the same, and it's consistent across the board. Now, this is a lot to look at. I will acknowledge that this is not the most fun thing. If I first got a credit card and I was 19, I'm not going to look at this and say, oh, what's my APR? What's my balance? I don't care about that. I just want to spend money. But this is the best place to begin when you're shopping for new credit, to review and say, what am I really getting myself into? I had an old mentor tell me the devil's in the details, and it's very, very true, especially with situations like this. I don't want to go too deep into it, but I'm going to highlight a few key features. This APR right here, the 0% APR intro for the first 12 billing cycles, what this is really saying in a really complicated way is for the first 12 months, for the first year that you have this credit card, it'll actually be a 0% interest rate. And that's pretty cool. However, it can be a bit misleading in a way where that expires after that, after the first 12 months. And then it jumps from 0% to 11.74 to 17.99. And this is actually an older Schumer box. The rates are significantly higher. They can be as high as 29%, and that all is based on your credit worthiness. This phrase right here, credit worthiness, is impactful because this is a callback to that credit score. So depending on that credit score will depend on what your rate is when it comes to this credit card. It depends on your interest rate. It's all interconnected, and it's great because you're able to influence one thing and have it trickle down and affect other things in a positive way. But the inverse is also true, where if it starts to get negative, you will start to see the negative impacts ripple, and those repercussions can be lasting. You also want to see APR for cash advances. This is when you're going to be taking out cash from your credit card. And again, APR, you want to pay interest rate on the cash that you take out from your credit card? Uh, it's not, I wouldn't. If you have the cash and you're able to just kind of pull it out from your debit card, go for it. There's no need to pay interest rate on your cash. I understand if you're in a financial situation, emergency, and you need it, but you want to know, what am I actually paying for over time? Oops, there's also balance transfers where you're able to transfer balances from other credit cards into a new one and potentially use some cost-effective and savings tips to pay the balance down while there's no interest accruing on it. And that can be a financially sound situation, but again, you want to take into consideration your own financial habits and take it seriously. Can you do it? And you don't want to utilize the credit card as you're paying the balance down, because if the balance doesn't get to where you would like it to be after those 12 billing cycles, you're right back to that 11.74%, 17.99%. And if you're transferring over from a different card and that card had a lower interest rate, and now you've now taken that balance plus then some and added it, it's now 17.99%. This is accrued like monthly. It's not, it's a little, it's not fun. The best way to avoid getting into the nitty gritty and the details of this is to pay your balance off in full. Pay it before the due date, and normally a due date's about 25 days after the close of each billing cycle. So I'm not going to go too much more into this. I do want to highlight some of these things so that way you can start to be a bit more knowledgeable and a bit more ready when it comes to looking for new lines of credit. So that way you know what you're getting into. There's also some of these fees. Some cards have annual fees. This example does not show that. There's balance transfers and whatnot, late payment fees, replacement cards, and you want to be aware of this. Sometimes you're able to not have an emergency card replacement. $50 for an emergency card replacement fee, that's a lot. And these institutions are able to charge this as long as they disclose it to you. And because you were disclosed, or it was disclosed to you, you're expected to read it and say, well, did you read the fine print? No, I did not. What's going on? And before you know it, you have spent a lot of your finances and your income has been spent towards just maintaining this card and fees and whatnot. Don't pay fees, take vacations. So looking into this, you may have received a lot of credit card offers in the mail just like this, and you don't want it to happen anymore. You are able to request to be opted out, and you don't have to receive them anymore. Sometimes they're great, sometimes they're bad, or if you just don't want the mail, I'll put this link in the chat. I think Medallia might have already done so. Let me see. No, I'll put it right there. Boom, that's out. Pressgreen.com if you no longer want to receive any more solicited offers. We also offer some Smart Rewards savings accounts as well. We offer them through huecu.org/smart rewards. They're a great way to take advantage of our now 4% APY and earn that higher interest on your savings account, as opposed to potentially having interest on loans and whatnot. It's a great way to take advantage of what we have right now. We also have a blog at blog.huecu.org where you're able to learn a bit more, keep up to date. We post very, very frequently, so that way we keep our information relevant and appropriate to what's going on. Full disclaimer, this presentation has been just a general overview. It's been educational only. This is not legal or tax advice. Please don't sue me. I'm doing this and the credit union is doing this for the sake of being a benefit for you, HUCTW, so that way you are able to be a lot more knowledgeable about the financial world out there and be prepared when it comes to making those big financial decisions. Now, this is not the end of our presentation. I know this has ended, but now I'm going to jump into the Q&A and answer some of these questions that may have come up so that way I can tailor my answers and give you the best value possible. So first question.
Thanks so much, Terrence. I just want to jump in. I know that people are submitting a lot of questions and just want to thank everyone for doing that. Also, just being mindful that Terrence is going to be answering general questions. A lot of the questions that are being submitted are very personal. So I am going to put again the Green Path link and just remind folks that if you have very specific questions, you can contact Green Path as they are accredited credit counselors and can speak to your specific information, but Terrence will give more general answers. So if you don't see your question answered live, just know that you can contact Green Path.
Awesome. Thank you, Migdalia. First question, is Credit Karma a good source to check your credit? So I'm going to answer that question very strategically. So a good source is yes. So you can check your credit score for educational purposes, and that number may or may not be accurate. Credit Karma, your banking app and whatnot, it's a great place to check. It may not be the exact same score that is pulled when a lender does a hard pull, because the information that is being pulled by Credit Karma is just it's a quick glance. It may not go into as much detail. It's a great way to keep tabs on what's going on, to see big impacts reflected. I have nothing personally against Credit Karma. It is a useful tool if you're using it for educational purposes, but I wouldn't base your financial decisions based on the score that you see in Credit Karma. I would 100% maybe reach out to a lender or visit other places to see, hey, exactly what's going on, or pull your credit report. Your credit report is the best place to go to see very accurate information. Next up is recently took an auto loan instead of purchasing with cash in order to help my score. Is it possible to pay off too quickly? Um, s- that is up to the individual loan. There is what's called prepayment penalties, where there actually could potentially have a negative impact on you if you pay off the loan too quickly, and that is up to each loan. Not all loans have prepayment penalties, but it can be in the terms and conditions. If there are no prepayment penalties, then potentially no, there's okay. The trade-off is you may not get the foundational length of having that line be paid off and paid in full over time. So the more time you have with the loan, you may want to it's just, if you're first starting out, having some time with it may be good if you're looking to get the benefit that way. But if you have a good foundation, I wouldn't say it's a bad thing. But again, very, very specific and very important. It is up to the loan if there is a prepayment penalty. Next up, assuming a good/very good current FICO score, minimal to no minimal revolving debt carried month to month, and no history/term of installment debt. Would a term/installment loan be a useful mechanism to improve mortgage eligibility down the road, even if the extra cash isn't needed? How critical is debt diversification? Great question. As we saw earlier, debt diversification is about 10% of your credit score. So it's not going to be, I think, 10 to 15%. It may not be the most impactful. And if you have a very good current FICO score and no minimum revolving debt, it sounds like you're already in a great place. You may not get the same reward that you are expecting to receive by opening this new line. It can be useful, but if your score is already a 720 and you're looking to get into a 750, in terms of how you'll be treated with that extra 30 points, it may not be financially relevant. By that, I mean, you may not save any more in interest. If you get to that top tier, once you're there, you're there. You're not going to get extra money off. If we've already given you the best, you already qualify for the lowest rate, you may not get any lower. It is what it is. If you're just starting out, maybe possibly look at it. But if you're already in a good spot, I say you're good where you're at. Debt diversification, again, as I mentioned, is only about 15% of your FICO score. So it's not critical, but it does matter. If you're in a good place right now, I would stay there. Next question. Is it correct that FICO score releases only after 6 months since credit story begins? Huh. So your credit, I hope I'm understanding your question correctly. And I think what you're asking is how frequently will my credit score reflect changes once I start making impacts or positive impacts to my credit score? Because of the way reporting happens with your credit card and how it reports 1 month after it's closed and whatnot with the balances to the credit bureaus can take anywhere from 30 to 90 days to have that reflected on there. And I don't want to give you a specific time as far as which credit bureaus report on which timeline, because as I mentioned earlier, each credit bureau has their own timeline, their own way of doing things, and each lender will report to each credit bureau at their own leisure. Granted, they have to say, like, yes, this person made payments on time, but I would say usually 6 months is a good length of time to start seeing some changes if you have been making a positive conscious effort to make positive changes to your credit score. So I'll say 6 months, you should start to see some changes. You may see some changes sooner than that. You may see some changes later than that, but I wouldn't hold to, I need to see it in exactly 3 months. I'd say about exactly 6 months. The sooner you start making progress and the sooner you start making positive impacts to your credit score, you want to get a jump on it. So that way, when you are ready to buy that big purchase or look for that line of credit, you want to be in the best situation possible. I wouldn't time it in that way because it's always great to have a good credit score if it's something that's fits in your financial future.
Thanks, Terrence. I read the question a little bit differently, so I'm just going to add my
Sure.
answer as well. That way the person can have both. I read the question as if they just started credit, will they get a score in about 6 months, which is usually true. That is usually the case. So no one starts with a bad credit score or a high credit score. You essentially start with a credit score that is based off of your spending habits. So if you get a credit card today and you didn't have one before, you're not going to automatically get a credit score the next month. So everything that Terrence was saying about how long it takes to build the credit and all those changes reflecting is correct, even if it's the first time that you're opening credit. So if it's the first time that you are opening your credit account, a credit card, a loan, it usually will take about 6 months before you have a credit score issued to you, but can sometimes be lower or could be faster or take a little bit longer sometimes, depending on your situation.
Awesome. Thank you for sharing that, McDowell. She's been doing this for longer than me, and I value her feedback and her advice. Extremely valuable. Next question. Is it bad to open a new credit card and not use it? So bad, I want to touch on that. I first want to ask and assume the question is this. Are you looking to, what impact are you looking to have by opening this new card? If you're looking to have this new card positively impact your credit score, you have to use it. And you have to use it responsibly, and you have to use it within terms so that way you are getting what you're looking to get out of it. If you're opening it for the sake of opening it just to have it and not use it, why open it in the first place? And that's how I want to go with that. Next question. There's two questions actually. How negative is switching credit cards? I'm considering getting rid of one of my older card for one with a better perks. And does having too much available credit have a negative impact? My credit cards keep increasing my limit, probably because I always pay in full. Thanks. Okay, great questions. And I would say if you are considering closing your older credit card, that can have a potentially negative impact on your credit score because you are essentially closing down and erasing the history, and it sounds like good history that you've developed using that card. If you do want to switch, by all means do switch, but I wouldn't completely say, okay, I'm done with this card. If you're closing out that credit history, because we did acknowledge earlier, 15% of your credit score is credit history. And if you have a very long good history that you have that you've spent time working for, don't erase that. But if you don't want to use the card anymore for better perks, I would still set up a automatic payment, Netflix, whatever you need to, one bill or two bills that are super, super small that you are able to set up automatically so you don't have to worry about it anymore. You don't have to keep it in your wallet anymore, and set it up so that way it pulls from your checking account every month to pay itself off in full. So you're still paying for Netflix or Spotify or Apple Pay as you would normally, but you set it and forget it, and you no longer have to worry about it. And you can switch your focus and your active spending to the card with the better perks without potentially losing out and closing on the older, I'm assuming, good foundational history that exists with the older credit card. With the second question,
Oh,
does
sorry,
have,
Terrence.
yeah,
Before you continue, so I actually have a very different take on this one, and everyone's credit is personal. So again, I'm going to recommend folks contact Green Path Financial Wellness directly to speak about your credit situation. So in my case, I have closed my very old credit cards. They just were not serving me. The interest rates were high, and I am a big believer in simplifying our finances and not having too many credit cards open. And I've closed the card that I had when I was 18. I closed, most recently I've closed 3 of my oldest cards, and my credit score is very high still. And that is because in my credit file, it would they look at the average credit history that you have. So if you're in a situation that you only have one credit card, let's say that you opened 10 years ago, and then you have a credit card that you opened a year ago, then in that situation, opening that older credit card will have much more of a negative impact because you're losing all of that history and only have the history of that card that you opened 1 year ago. However, if you're in a situation which is more like the situation I have been in, where you had multiple credit cards, had student loans, car loans, mortgages, and your credit file is thicker and has more credit history, closing a credit card that, it's all about the average. So closing a credit card that was older may not have as much of a negative impact. Also, keep in mind that you want a high credit score, always, of course, but you specifically want it when you need credit. So if you are thinking about closing a credit card, I would think about the timing. Am I going to be applying for any other credit cards? Am I going to be applying for any other loans? If I don't have any need for credit in the next year or two, or I don't anticipate any opening additional accounts, that's usually when I will close the older accounts. So yeah, sometimes I personally have seen a dip, maybe 2 to 3 points, but still, high 800. So for me, it did not have an impact. But again, my file was a thicker credit file. So I would recommend contacting GreenPath. They can do credit simulation, and remembering that everyone's situation is a little bit different. And it's not just that one card. You have to think about the entire credit portfolio or the credit file that you have.
awesome. Thank you. Midali brought up a really, really good point. We are in very different financial situations. And again, one answer is not going to be one size fits all. Next question, does having too much available credit have a negative impact? No, not even a little bit. My credit cards keep increasing my limit. Probably no. Having too much available credit has zero negative impact on your credit cards and your credit score whatsoever. It's a great thing to be, actually. If you keep your utilization low, that just shows like, you know what, you're great. And that's probably why you keep getting an increase, because you've had such great habits.
Yeah.
So
The only time that it could sometimes impact is if you are applying for other credit cards, or if you're applying, let's say, for a mortgage or a car loan, educational loan. There are times, depending on the lender, remember, every lender is different, but there are times, and we've heard of lenders that will look at how much available credit you have and decide to not give you
oh,
another credit card, because let's say you have $60,000 in outstanding available credit. So then why are you looking for an additional 20 or 30? That could make you sometimes a little bit more of a financial risk for a lender, assuming then you were because then you have access to all this credit that you could utilize at any point. So some lenders, if they don't have as much funds to lend, they may be a little bit more selective and choose to lend to individuals that don't have as much available credit, because that means to them that that individual is less likely to take on additional debt and not be able to pay it. So they are, like, I, agree with Terrence, definitely doesn't impact, it's possibly it does impact the credit report and the credit score. But remember, this is just a part of it. There's also underwriting. There are different, formulas that lenders are looking at behind the scenes or building into their automatic processes. And sometimes having too much available credit could have a negative impact, but it will depend on the lender. And it's not, again, not always the case, but there are times that it could. So if you ever denied, long way of saying, if you ever denied credit and you not sure why, I would contact them and ask them, maybe it could be because you have too much available credit and are seeking more.
Awesome. Thank you, Redalia. Next question. Very interested in how you fix a bad score, contact lender, and update credit bureau. I'm not sure if this is a question, but yes, you would want to contact your lender. You want to pull your credit report for one to see exactly what accounts are negatively impacting you. And usually when you pull your credit report, there is a number associated with them. So you can, if it's in collections, you can contact the collector agency and see if you can pay it off in full, or if you can enter a payment arrangement. You could also contact GreenPath and they can pull your report to see exactly what situations and what accounts you need to fix and how you could fix them. I don't want to give you specific answers because there's a lot of different ways to do that. Last question, what should we look out for when choosing a beginner credit card? Is there a difference between getting a secured card versus an unsecured card and with a lower credit limit? If you're looking for a beginner card, personally, my recommendation is a secured card just as you're starting out, so that way you are able to kind of get the feel for it, see how it's going, and that's what I recommended for my niece Selena. So that way, there's no potential negative impact. That the impact will be small if you happen to kind of go above your limit or you want to test out your spending habits. Starting with a secured card is my personal recommendation. Everybody's going to be a little bit different. But I don't know if you want to add something, but for me, secured credit cards is my preferred way of starting out, and at least for about a year to maybe a year and 6 months to see how it's going and to see if there's been any impacts to your credit card.
Yeah, I think that's a great strategy. Depending on the financial institution or depending on the personality, another approach is if you wanted to start off with a credit card, even if they give you a higher balance, just ask for a $1,000 balance, ask for a $500 balance and it not be secured. So and that's in general, you don't have to accept the entire credit balance that is offered to you, and excuse me, the credit line that's offered to you. And I say this because everyone's financial personality is different. For some individuals, having a higher credit limit means that you'll spend more. For some folks, it doesn't really impact them. So if you ever find yourself in a situation that you're like, you know what, I want to just have a credit card that's not secured, but they gave me too much of a high credit limit, just contact them and ask them to reduce it. That is also an option.
Awesome, thank you. And I know we're closing out. We have about 3 minutes left. I see some more questions coming in. Thank you so much for your engagement and participation so far. This has been phenomenal. Let's see. Oh, okay. I don't see any other questions coming in, so are we good to end, Migdalia? Anything else that you want to cover?
Yeah, no, thank you, Terrence, and thank you everyone from HUCTW and Danielle for joining. I know that some folks had some additional questions. I put in GreenPath's information. So for the very specific ones, please give GreenPath a call. It is free to you. We pay for it, so it's available to you for free. You can contact them multiple times. You can have a file account that's created for you with GreenPath. So if you have questions down the line, you can call them again. They can pull your credit report. It does not have a negative impact on your credit score. So just reiterating what Terrence has said, definitely give them a call. They'll be able to answer those very specific questions that some of folks had that, we want to make sure you get the best answer. And the best way to do that is to have someone go through your credit report, and they could do that for you for free. We paid for it, so you don't have to worry about that. We took care of that part, but just give them a call at any time.
Awesome. Thank you very much, Victalia. Thank you very much for Danielle. And thank you everyone for joining us today. I hope you learned something. And again, if you have any questions at all, please feel free to contact us at my HUCU. This recording will be available on our YouTube page. And thank you for spending an afternoon with me. Hope you have a great rest of your Thursday, and I hope to see you again in a presentation in the future.